For those of you who've joined, I'll give it another 30 seconds or so, and then we'll get started. Welcome to another episode of the New York Alternative Investment Roundtable's Lunchtime Webinar Series. My name is Jason Eisman, Assistant Vice President at Hub International and moderator for the webinar. For those of you who are new to the Roundtable or unfamiliar with the Roundtable, we're a nonprofit organization whose mission is to provide a forum for both thought leadership and knowledge sharing in the alternative investments industry. We do so by hosting monthly in-person events and monthly educational webinars such as this one. If you're interested in learning more about the Roundtable, please visit ny-alt.org. We're able to do all of this thanks to our sponsors. If you're interested in learning more about membership or becoming a sponsor for the Roundtable, you can reach out to me or again, visit the website ny-alt.org. This webinar is going to be recorded, so please, if you know anybody who was interested in viewing the webinar but wasn't able to make it, please let them know that this can be seen. It'll be posted subsequent to the webinar. A few more items. I just want to let everybody know. Um, I think that's really it, actually. With that, I would like to turn it over and formally introduce all of our presenters. While we're going, please feel free to use the Q&A. If you have any questions, we will monitor that. And as the questions come in, we will do our best to address them. If not, we will go through everything during the Q&A at the end. That said, Neely, turn it over to you.
Yes, hi everyone. Neely Pilot. I'm a managing director and operating partner at New Mountain Capital, a private equity firm that operates in the middle market space with around 60 billion in assets under management. I've been with the firm for 6 years now, and in my role, I lead office of the CFO. I partner with our CFOs on their finance functions and also lead the CFO community.
Thanks, Dimitri.
Hi, everyone. Dimitri Drone, Managing Director at Houlihan Lokey. Been over here for about 8 years. Before that, I was at PwC for 27 years. At Houlihan, I co-lead one of the valuation practices, the one that focuses primarily on valuation work done at the company level. Most of our clients are sponsor-backed companies. Thanks.
Thank you. And Jeff.
Hi, Jeff Glick, CPA. I work for OCFO, stands for Outsourced CFOs. We help companies become bankable. Those small, mid-sized businesses that are growing and they want to do their first material transaction. It could be a merger, an acquisition, or someone might want to buy them, or a bank loan. And we help them install proper infrastructure in their financials.
All right. Thank you, everybody, for that. And it's going to be a great panel, especially given that we're going to be discussing financial infrastructure that drives returns. And with that, Jeff, the first question I have is for you. Once a company is determined that its goal is acquisition by a private equity firm, as a CFO and as a CPA, what are the first areas that are targeted to create intrinsic value and scalability for that business to increase its future sale price or valuation?
It's pretty basic to a certain extent. Having been on both sides, on the PE side of acquisition and selling, you want to prove that you have policies, procedures, internal controls. Your reporting is timely, accurate, consistent, and you track key metrics and benchmarks, and your reporting is strategic. That's just the start, and that's the groundwork that people start with. If that doesn't exist, it's a big red flag. And then the acquirer is going to have possibly issues about your financials as they dive in deeper into due diligence.
So you mentioned they're going to dive in deeper into due diligence. So let's just start earlier on. Let's take it a step back. So
Okay.
it's a newer company, and now they've decided in 5, 10 years from now, our goal is to be acquired by a private equity firm. So it's a
Hmm.
smaller company. They might not have much of anything in place, but they know that there's some place to go. They're going to create the roadmap. So
Yeah.
what's that first thing that they're looking at? You mentioned a few different things, and I'm sure not all of those are created equal. So which is
Um,
that top one that they're going to look at and try to start to implement right away as it has impact on their ultimate sale price down the line?
right. So, all these things like internal controls, policies, procedures, that has to be built up as the company scales. So some companies might not be able to afford everything because they're working on intellectual property, new products, marketing. So it has to be scaled relative to the size of the company and their budgets. But they should look at this as an investment and not an expense. So the first thing is just to make sure that when they're spending money, it's approved by management, it's approved by the board, and they know where they're spending the money and why they're spending the money. That is the key. And as you get larger, you have more layers of management, perhaps, or you invest in better technology. And with things going now with AI and all this, it could be less expensive, but you still have to have the people who can review it and understand it.
Got it. That makes sense. And now, Neely, uh, piggybacking on what Jeff was mentioning, so he was talking about cost, looking at cost and reward. So, are there differences in how private companies and private equity firms view the importance of financial systems and infrastructure? I guess, can you handle the private equity side? And then I'll ask Jeff to chime in and give some more information on the private company side of this.
Yeah, I think, maybe, and just to build on that and expand the question, I think, we work with our management teams, right? So it's really, and it really depends on the management team. I'll just speak to that first. Um, Typically in founder-led companies, they've been able to get along without a real infrastructure. It's not because they're doing anything wrong, they've just been able to, right? So they have their spreadsheets, they have their skilled people. And they look at investment in financial systems as disruption, or as Jeff mentioned before, an expense, not an investment. Versus, a more seasoned executive team who's kind of been through a turn before, and usually the private equity sponsor as well, understands the value creation in a proper system. What's most important, kind of going back to your question for the firm, is really the data integrity, the reliability. How quickly can I get my numbers? How reliable are the numbers? And how accurate is the forecast? So they're not looking at it just as like we need financial systems to have financial systems. For the firm, it's more about the integrity and reliability, and also in order to get that to our LPs. The enablers are the proper financial systems. And what's also critical here is that we don't need the Cadillac system. We need good enough, which I think is a really important emphasis as well.
All right. And Jeff, do you have anything to add on that from the company side?
No, and she's absolutely right. It has to be accurate, timely, and it has to be in proper scale to the size of the company. And from the PE side, they also view this as it could be a gift in that they know that they're going to take a discount on the valuation because they don't have these internal controls and et cetera. And they know if they put them in, that they're going to see an immediate return on their investment in those because the valuation will go up.
We're going to come back to that valuation piece a little bit later, but Neely, just a follow-up again. So you mentioned we need good enough, and the systems that we have in place are a means to an ends, which are data integrity, reliability, and the ability to provide accurate forecasts. So how does the sophistication and comprehensiveness of a company's financial system and infrastructure differ based on size and or industry, if at all?
I wish that it did differ based on size and industry, but from my own experience, it really depends on who's managing the company. Like you can find 300, $500 million businesses that are running on pretty manual process and much smaller companies, maybe that Jeff's worked on, that have more scalable infrastructure. So really it tends to really be determined by who's running the company and where are they in the evolution. And so, if it's founder led, or do you have a more seasoned executive team, right? Like we mentioned before, and is this the first time the company is taking on institutional capital? Founder-led businesses, pre-institutional capital, just happen to have systems that are, good enough, but maybe not necessarily built to scale or for a lot of M&A. And then once you bring in experienced operators or outside investors, there's usually a step-up function, right? So, and how people think about infrastructure. Industry does play a role because if there is more sophisticated rev rec, maybe that does need more sophisticated systems. But again, they typically get around that with spreadsheets. So, um, you know, the baseline expectations, clean data, timely reporting, some level of forecasting, that's pretty consistent again across sectors. So I just to go back to the prior question, to me, it is from what I've seen, the level of sophistication really relies, it's more differentiated by the management team than anything else.
Okay. And we keep mentioning you, or both you and Jeff have mentioned the data integrity, reliability, and forecasting. So it's all information and data related that's useful to both the company and the private equity firm. So I'm going to open this question to everybody. And Dimitri, we haven't heard from you yet, so I'm going to jump to you first. So each of your perspectives, what's the financial process or system or infrastructure? So it's a broad question that's most important. And why is that specific system, infrastructure, or process most important?
All right. From my standpoint, historically, I would very much put, I'll say, the financial management team as the priority. You know, they know what to do, how to do it, getting things done, having the authority and ability to make changes, updates. That's on the management team. And I think that's incredibly important. I would say that in today's age where AI seems to be, a part of everything, I say that that's probably becoming a very important tool for companies to use as often and as many places as possible.
So the management team and AI, those are the two most important.
Yeah, and I don't necessarily think that AI, causes other things to become obsolete. I think that like management teams that become proficient at how to use AI in their operations become even more valuable and more sought after.
Okay, and I apologize to press, but the management team, so does their knowledge and expertise, can that have a direct impact on valuation? Or is it more so just what they can do or what they do that ultimately impacts the valuation, being performance and efficiencies and the ability to provide accurate, detailed data and information?
So I might flip it on its head, meaning I kind of think of it in terms of you assume you have a strong management team or a strong enough management team, the value of the business is X. As you start to learn more about the management team and see that they, aren't able to do certain things or do it timely or do it reliably, you start to deduct from it, right? So I think that it's assumed that you've got the right team in place. And as you learn and see that they can't do things the way that you wanted them to get done, you might see people take off a turn or two or something like that along the lines of the multiple that you might apply to that business.
So my understanding is it's not necessarily that you're going to start at a valuation of Y and move that valuation higher based on the management team, but you'll start at a baseline and you will reduce value from the overall company based on the inefficiencies of management or the lack of certain capabilities of the current management team.
Where I've seen it more often kind of somewhat explicitly factored into the valuation, it's been more of a deduct. I
Hmm.
would tell you that I think that a lot of times sponsors will help incentivize management teams through the use of equity awards. And so that may be a way to try to get the value to go up and up in terms of, you hit certain thresholds, management team, you can now share in some of the upside with us.
Understood. Now, Neely, I'll ask the same question to you.
Yeah.
Which,
I'm going to be a little controversial and disagree with Dimitri, if okay. I do agree with him. I think at New Mountain, we talent is of the utmost importance. I totally agree. But I think in this day and age, it's sometimes hard to maintain talent in place, let's be honest. And so to me, like process, AI is definitely important, but if you don't have the right process behind AI, you just have AI, which is a good buzzword and it probably could rewrite your multiple, but ultimately you'll find that you just have AI, but no one's doing anything with it. And so really it's about the process behind it that's a critical enabler. To me, month end close as a financial process is the most important thing because as we were talking before, having the information timely and accurate, that could throw up a process. If your buyer does not believe in your data integrity, that's definitely diluting your multiple. And could even, that's where they kind of deduct from the EBITDA as well. So it could be a double negative. So really having a great month-end close process that definitely can be enabled by tools like AI. You should be putting AI in all your workflows, but if you don't have the proper process, you just have a fancy AI tool. So having the right month-end close with a checklist, with the right reconciliations, which by the way, should all be enabled by AI, will help you get the right data that you feel confident in, will help drive the business, give timely visibility to drive the top line, which is the best way to drive value creation of the company. That can be managed by any management team. I mean, I want to say I agree with Dimitri. I think talent is of the utmost importance, but I think we're living in a world where talent is fleeting. And you may buy a company with a really great management team and they may leave after a while, and then you just have what they've left behind. So really making sure when you're diligencing that they have the right processes in place is where we would re-rate the multiple and pay for that.
so I guess you need the management team to kind of right the ship, get everything in order. And once the infrastructure systems and processes are in place, you can effectively have any management team come in and utilize tools such as AI.
Yes.
So the management team is important at first, and their degree of importance, I guess, isn't diminished per se, but it can be. I'm nervous of how to phrase it, but the management team can be replaced, and the operation can still run as long as the foundations are there.
I don't think that's correct. You can't have anybody in there. People have to have, knowledge, expertise, and know how to manage. It. I think that's something, when we look at companies, besides the financial infrastructure, do they have franchise value? If they lose certain key members of management, will their customers leave? And that's another aspect to this as well. And when you're valuing a company, is the core management team, are they the ones that bring in all the money? Or have they built the right processes? Have they hired the right juniors, mid-level salespeople to take over those accounts? So when, God forbid, someone gets hit by the yellow school bus, the company isn't in tatters. And I think
Right.
besides investing in financial infrastructure and all that, and Neil is 100% correct. That's what OCFO does. But having been on, and Neely knows this, and Dimitri knows this, that you need that franchise value. Is this worth anything if management leaves? And that's the key. And that also impacts the valuation. It also might impact the earnouts and everything else. So there's a lot that goes into all of this.
Has to come
Right.
together.
Absolutely. Right. So for the sake of the conversation, I think we're focusing more on the
Absolutely, yes.
financial
Right.
side of things.
Mm-hmm.
So from the financial infrastructure aspect, that
Right.
perspective and the value creation. So for there, you have the foundation, you have the processes and systems. Once you have that going where you can provide the accurate information, which is what I think what Neely is saying. The management team put that in place. A new management team might come in, but your infrastructure is sound. The reporting and data quality, which my understanding was the most important piece that we're talking about right now, because that's the information that everything is based off of.
Most important, but not only, I think tying into what Jeff said, it really needs to come together. It can't be
Absolutely.
on its own. Like you can have an awesome management team, but not great infrastructure capabilities, and then it's very manual and everything is slow. You really have to have both to be successful, I think was the point I was trying to make. You really have to have both in place.
Absolutely. No, that makes sense. And nothing can be looked at in a vacuum, of course. You need to see the broader picture and how all the different pieces fit together. And I absolutely understand that and I agree with that. And
Mhm.
now we'll just move. We spoke a lot about quality. So, Dimitri, how does the quality of the underlying financial systems affect the confidence interval you put around evaluation? So, are there specific data or financial systems that have greater impact on widening or tightening that confidence interval for a given valuation?
If I understand the question correctly, are you saying if the more reliable the information, is there a premium placed on that?
Not necessarily a premium. I think this goes back to, are you detracting value if there are processes in place, but you say, I can only moderately rely on that data because based on the process that they have in place, I'm not absolutely comfortable. So it was
Okay.
going back to what Neely said with the good enough processes and systems that will give you the data, but if it's not the best and absolutely reliable, is there any valuation impact based on the degree of confidence?
So less reliability will very much, at least in my experience, translate into people having wider ranges of value and probably, looking more towards, downward revisions, all things being equal, right? There, look, credibility means a lot. And when people put forth a forecast, you want to have as much confidence as possible in terms of can they hit this, right? And so if the information coming out takes a long time, has a lot of adjustments, let's say manual topside adjustments to it, yeah, in my mind, it makes the information less reliable. And at the end of the day, all things being equal, that would probably pull values down and or maybe make the range of what a value of this business is wider, but probably more skewed on the downward.
Right. So there's definitely a downward impact. Is there a way to, would you be able to quantify that to say how much of a drag that would have on valuation on that range? Or is it case by case? It's not easy to just say that this is the impact that you would expect it to have based on the degree of confidence.
Look, you might take a business whose value range is maybe plus or minus, let's say plus or minus 10%. That's a pretty tight range. But maybe now it grows to 20, 25%. That's now a pretty healthy difference in value.
Yeah. No, that absolutely is. And it just goes to show that ba back to what Neely said and Jeff said, and everyone's in agreement with, the information is the data is what drives the valuation, a lot of the valuation, not all. I apologize. We just spoke about that. But Neely, when you know a target will need significant finance transformation post-close, how do you reflect this at all in the valuation? Is there impact from your perspective?
Yeah, for sure. I mean, it's a lift. I think it goes both ways, which I think someone mentioned before. I think Dimitri mentioned it. Like, if we know there's like a really great finance team, as Jeff mentioned, and really great finance capabilities, like great system, good process, monthly reporting, we will re-rate up. But if we know that we're going to have to build out the entire team, put in a system, I mean, first of all, there's a dollars investment. So there is literally, a deduct from EBITDA for that. But there is also a re-rate of the multiple because that's a lot of investment and work that we will need to do. So it really does pay off to make those investments when you have an investment like that, because we have also found that buyers value this as well. I mean, this is true value creation. It's something that we do a lot. As New Mountain's tagline is, we build great businesses. Um, but this is a process, it takes time, right? So again, I think there is tremendous value when we do the build that our buyers really value, and that will be reflected in our valuation.
Yeah, it's kind of
Okay,
like
that makes sense.
I was going to say it's kind of like a day one deduct for any investment you have to make, right? So in other words, the
Right.
business with 100, but you got to put 15 into it. You might offer 85, knowing that it's worth still 100, but 15 of it's coming from investment in, let's say, systems. But then presumably that will result in some kind of increase in ongoing EBITDA or cash flow, which then hopefully will translate into a higher value, all things being equal, over time.
Yeah, and that's what we do for our clients. We sit down and we tell them, listen, what Neely and Dimitri's saying, you are not going to get what you think you deserve for various reasons. And one of them is your financial infrastructure. Plain and simple. A lot of times it's a second, third generation business. Grandma, grandpa founded it, brother and sister really built a great company, might have sales of $50 million, but in the end, it's a lifestyle business and it's not made for prime time. And you have to make sure you're ready for prime time. And that's basically it. And Neely is right and Dimitri's right. They're just going to take off value that you should deserve if you made these investments along the way. And do it now might be better because now with technology, it's a lot easier to make those investments. And if you're buying a company, you want to concentrate on their sales, on their operations, on their manufacturing, not on their accounting infrastructure. That should help you manage the business better. But now you have to take 6 months or whatever to build that infrastructure. So now you know that the margin per SKU or per engagement and what that is. And if their overall margin is 50%, management and the investor group wants to know which ones are 75% and which ones are 25%. And those are the numbers that Neely's talking about, where that's going to help drive that business. And if you don't have that infrastructure, they're going to take a discount off of that.
Absolutely. That makes sense. Thank you.
You know,
And Jeff,
I do see a lot of companies spending more and more time and attention on trying to understand, the 20% of their business that drives 80% of the growth
Yep.
or bottom line impact. Because honestly, I think in today's environment, there's so many different directions you can try to go into, but I think that there's a lot of tools out there, many more than in the past, that you can use to be a lot more effective in terms of getting a return on the next dollar of investment.
so there's a lot more incremental value now with the tools and resources that we have versus historically.
The potential is definitely there.
Okay. And as we get more adept with AI and these tools, you think that we're moving in the right direction right now where we're going to be able to capitalize or companies should be able to capitalize on a lot of these things?
I think on the one hand, we have kind of information overload, like we have the potential to have way too many things to focus on. But for those that are pretty good at prioritizing and seeing kind of through the weeds, through the noise, whatever, that these are the things that are the most important drivers of our business, that's very useful at the end of the day. And it really comes from the systems. If you don't have the systems in place, you don't have any information with which to analyze.
Right. And Jeff, going back to something that you said about starting to play in the big leagues. So nothing feels more like working your way towards the big leagues than having a buyer approach you and start going through the process and going to the due diligence period. What does the due diligence process look like from your perspective
From the
as the company
buyer,
being acquired?
uh, the acquiring company, if they have good management, they should know the questions in advance and the answers to those that the acquirer will be asking. That's why a lot of companies do sell side due diligence. They're ready before it starts. And some of the things they ask about is what we've been talking about: policies, procedures, internal controls. They might ask, what's your return on invested capital? Have you had other acquisitions? And how have those paid off? And that's really a good show of management. Can they expand this business both internally and externally? And it's depending upon the size of the transaction, due diligence can be very difficult on a lot of people. It's time consuming. Uh, Depending upon the environment, there could be a lot of finger pointing. And that's why we tell clients, be prepared for it in advance, get ready for it 12 to 18 months in advance before you know something is going to happen.
So 12 to 18 month preparation period
Yeah.
for the company to get prepared. And that's what putting together documents. Is that the point where you're starting to visit the financial infrastructure and everything along those lines to make sure that the valuation is where you expect it to be?
Well, it's also to clean things up, especially if it's a privately held corporation and they're putting some personal stuff through, clean up the EBITDA adjustments, clean it up before it's not that's too late, but it just makes it easier. And then you can ride and drive the due diligence process to what is really driving your value. And that could be your products, your technology, and drive them to your long-term contracts with your suppliers, long-term contracts with your customers. That's what really gets people excited. And the valuation discounts because of finance should be just avoided as much as possible and do it in advance, because what happens is they're going to start asking for quarterly financials for the last 12 to 18 months or longer. And those have to be, what Neely said, timely, consistent, and accurate. And and they want to know, and they'll start looking at your tax returns, and they're not jiving with your financial statements. Why not? And have all that stuff prepared in advance. So it also makes you look better. You know, people invest in people, as Neely said time and again. That's what people want, is good, solid management.
Okay. And Neely, from your perspective, from the buy side, what does due diligence process look like?
So we'll obviously hire a Q of E provider. And, as Jeff mentioned, we would look into their financials typically, 2 or 3 years back, to look at the full P&L down to adjusted EBITDA. We would then review, from their scrutiny around between reported and management adjusted EBITDA and then pro forma adjustments. So that gets more attention and more scrutiny. And I think that's, again, speaking to the importance of the data and the documentation, because, okay, and I think to caveat all of our questions, it really depends on the process. If it's a competitive process, it really depends on how much you want the assets, right? But when it's not as competitive of a process, then there's more diligence into these items to understand how tangible and how real they are, right? So the more that there's been, let's say, pro forma, they've actually executed on the action, we're already starting to see results in the financials, but that's where there's heavy scrutiny. And then we'll also look into the things we mentioned before. What's the quality of the finance team? What's the quality of the infrastructure? How does their rev rec look? What does the monthly reporting look like? And so on. So that will all be done in the buy side process.
Yeah, one thing I've noticed is quite a few processes where potential buyers have kind of dropped out when the information has just been too painful to kind of obtain or get through. And it's not to say that they wouldn't have been interested, but they just don't have the time to really dig in that much unless they really want that asset in a meaningful way. So that can hurt from the standpoint of, look, you always want to have more people looking at your business than fewer from the standpoint of, you know, supply and demand. If you got one person looking at your business, then you're stuck with whatever the offer is from that one person. Versus if you've got two, three, five, or some reasonable number of potential bidders for a business, you in all likelihood probably will get some uplift and could be a meaningful uplift in the value just because of the additional players that are involved.
So that goes back to what we were talking about before. So I guess the question was originally asked if there's specific tangible value that is provided or that can be detracted based on the financial infrastructure, processes, and reporting. So here, it's not necessarily that it is directly impacting, but it can impact the competitiveness of the process, which in turn can have an overall impact on the valuation. If one company is reporting or valuing as X with no competition, to your point, Dimitri, there is no there's no negotiation, there's no alternative valuation that might have come in higher than what you're dealing with a specific buyer.
In my experience, the buyers don't necessarily know that they're one of one, but I think they can pretty much figure out if there's a small group that they're up against. So maybe they're up against one or two others as opposed to it's 10 people that are still very interested in the asset. And I do think that impacts the way that people approach it. And all things being equal, I think that you might, see a little bit lower value, all things being equal. So doing the dress rehearsal before you get to the actual performance, i.e. doing things like a sell side diligence process to figure out, look, what are people going to find when they take a hard look under the hood, right?
Mhm.
And then at least at a bare minimum, you know how you want to respond. You have time to think about how you want to respond to it. Maybe you ignore it, maybe you don't provide them with certain information. Conversely, maybe you be more open about things, although at some point you probably don't open up the kimono completely, right?
Right. So I'll ask each of you this question. Jeff mentioned the 12 to 18 month lead time to get everything prepared, and that directly relates to what you just mentioned, Dimitri, that you've seen. I guess some companies are not taking this time to get everything together, and there are implications on the valuation of the company. So, are you seeing this often where the information is not neatly and nicely put together, where you are seeing buyers who are looking at that and saying, I don't have the bandwidth and the capacity to decipher information. If this is how the reporting is, then that company might not be a good acquisition target.
I mean, I think it ties to valuation. I think we see a broad spectrum of companies. We see like really well prepared, have done all the things Dimitri said, have clearly done a sell side prep, probably brought in Jeff, like did all the things and it looks really good. But then we also have the companies that the founder decided the kids don't want the business, they're ready to retire, they want to go traveling, and we've had a relationship with them. The information isn't perfect. We're able to get comfortable with it. And it does play into the value. Now, is there a line item for that? No, but like it's implicitly in the valuation.
Right. But I guess the question is, are you seeing this more often than not, or is this something that's more of an outlier where the company's not in a ready position with, I don't know if the word is appropriate finances, clean financials. I don't know how to the adjective to use, but are the companies generally prepared when you go in for the due diligence, or are you seeing it more often than not where they are not?
The small, my experience, the smaller the company, the higher percentage that they're not ready.
Yeah,
Got
I'll
it.
I'll take it like this. If it's already sponsor backed, the sponsor usually has a lot of control over the process
Yeah.
that goes out. And so usually it's as good as it's going to get, right? So in other words, some sponsors may acknowledge that it's not pristine, it's not best in show or best practice, but it's as good as they're going to get and they're ready to go. I think that with, let's say, carve outs of big public companies, sometimes those are kind of a disaster, right?
Hmm,
Because there's a lot of infighting and a lot of people you don't really know what the historical picture looks like because it was part of a bigger organization. And then you got all kinds of like shared costs that need to get allocated. And I've seen those processes take years, right? To kind of pull things out of a broader company. That can't be value enhancing. I don't know if it's
right.
explicitly value destructing, but it's not enhancing the value. So long-winded way of saying if it's a sponsor-backed company, they're usually about as prepared as they could be when they go into the process. When it's family owned, when it's maybe a carve out of a larger public company, could be all over the map.
Okay. Now back to uh, our time frames. When there's an operational change that's needed to be made in the company, so is there a time frame for which the value is expected to be reflected in valuation?
I mean, the
So
more you've made the change, like it has to actually have played through and be executed. I mean, so I'll let Dimitri speak to like the actual valuation, but I think for us, it's more about actually seeing that they haven't just like said something, but actually playing through and we're seeing the change in the build out versus just like, oh, we just like we're implementing a new system. But implementing a new system is could actually be disruptive. So it's really actually seeing that it's landed and it's actually operating as it should.
So no
agreed.
explicit time frame. It needs to be implemented and the value needs to be seen. And that can take a varying amount of time depending on what the change is and what the expected results are.
Yeah.
Okay. And now, Neely, I have one thing that I was expecting to hear, but I didn't, so I'll ask about it, is we mentioned a lot of the reporting and the quality of the reporting. There was no mention of actual KPIs that are being monitored by the existing business that you as an acquirer would be looking at. Are KPI, how important are KPIs, the presence of KPIs versus the presence of quality information?
For sure, if the company already has KPIs that are deemed to be the right KPIs to look at, that's very helpful. But more than that, it's really the data underneath that enables the KPI reporting because if they don't have the right KPIs, I mean, that is a big part of what we do. If we have the data and can access the data, then we can just together with the management team determine like what are the right drivers of the business. You know, as businesses go through different phases, KPIs change. Doesn't mean they were
Right.
looking at the wrong KPIs before, it just means that the trajectory has changed. So the KPIs within themselves aren't as important as the underlying data and the ability to pull them in a timely manner.
Okay, that makes a lot of sense. So there's importance, but I guess it all goes back to the data. The quality of that data is what drives the KPI reporting. So if you don't have accurate data, then your KPIs are moot because they're based off of
They're late
untrustworthy,
and they're
unreliable.
wrong. Yeah, they're late and they're wrong and you don't have them. So yeah,
Garbage in, garbage out. That's the,
exactly.
yep.
Okay,
As Neely said,
understood.
it's worthless.
Understood. This was extremely informative for me. I learned a lot about the process. I learned a lot about private companies. I learned a lot about acquisitions, what you're looking for. So when I start my next company, now I know exactly how to best prepare myself for the biggest valuation or the best valuation, a competitive bid process. Those are all the questions that I had. I'll open it to the floor. If there are any questions from the audience, please use the chat box and you can post the questions and I can read them for the panel. I'll give a few seconds for everybody to start putting their questions down if they have any.
Yep.
Uh,
I guess you did a great
It
job.
was it was a very thorough it was a very thorough, detailed presentation. So I do know that we went through a lot. I don't think there was a lot left unsaid, but just in case, we'll give it a few more seconds in case someone is slow to type. Hold on, there's a question around timing. When do we retain your services and how far in advance of an acquisition? I'm guessing this is a question for the OCFO services to
Like
prepare.
I said, it. Well, I think we could all answer this question. From this. Oh, CFO. Okay, that's me. Okay, so I would think, depending upon the scale of the company and kind of what needs to be accomplished, I think we should look minimum 12 to 18 months, maybe 2 to 3 years. And if you have a strategic plan to do something, this should be in your strategic plan.
Thank you, Jeff.
Yep.
All right, we'll just wait to see if any other questions come in. But with that, Neely, Dimitri, Jeff, thank you guys so much. This was an incredibly informational and exciting and interesting episode. Thank you guys again.
Thank
All
you.
right.
And
Thank
thank you everyone for
Yeah,
joining.
Thanks for the invite.
You got it. Have a
thank
good
you.
one, everybody.
Bye-bye.